Because you're a classic. Why don't you should kick us off? Because explain the dynamic. Your company, 300 million roughly in revenues, EBITDA, forget it's been growing, but you're trying to grow with debt and or equity.
So I'm actually exactly what my colleague from OIC described, and I've actually spoken to his colleagues at OIC. So yes, I am an industrial privately owned company, about 300 million in annual sales. We've got 4 portfolio companies spread across North America, 2 in the US, 1 in Canada, and 1 in Mexico. I would otherwise be eagerly checking in on the speech by the current administration and what's going on with tariffs that's about to kick off right now. But I'm here with you all. And basically, yes, I have an acquisition that I've just signed an LOI for. I have some new business launches that are in the works, including one that's in supplying metallic assemblies for the solar panel industry. But primarily right now, I'm in the automotive industry, and I'm at about 300 million in combined sales, about 10% EBITDA, and looking to get to that 400 plus million range in the next couple of years, and in search of some growth, capital, and financing.
How do you think of equity versus private credit? And I know you try to use the traditional banks as much as you can.
Traditional banks have been a big part of it. Equipment financing has been a big part of it. I would say, somewhat agnostic. It's about finding the right partner who has a vision for the future and an appetite for automotive is really the key. I mean, automotive does very well in good times and has certain risks. We're seeing the tariff risks right now. We've seen the risks associated with strikes in the past. I've definitely had my ups and downs since I entered this business almost 30 years ago, and I'm still standing, and I've grown along the way. But yeah, it takes certain times. I spent a lot of time talking to people both in these conferences and in the business, and they express an interest, but not everybody really has the vision or the desire to be in manufacturing and in automotive.
Why should they bite? Why should
they should bite now because of all the reasons that have already been discussed, right? With the tariffs that are going on, with some of the transplants that are talking about now increasing their footprint in the U.S. Hyundai announced their plan to invest $20 billion. There's a lot of growth and a lot of opportunity that we're going to see. Something's going to shake out as a result of all of these movements back and forth. And I think entrenched, well-situated, diversified companies like Bear Diversified are in a very advantageous position, as long as they have, like we have, already put in place a lot of the capital infrastructure necessary to expand and take on these opportunities.
And I'm going to switch gears. So we'll place marker that. Matthew's looking for partners. So I think maybe Julian and Eddie, and then we'll come back to another situation that we take equity in debt. But Julie, it's been so long. It feels like, was it Chicago? No, you came to New York.
Yes.
So you've been doing.
You still look fabulous, Mark.
What's that?
You still look fabulous, Mark.
It's birthday. Okay, that's birthday. Well, tell us what's been happening and how you see the world today. What scares and excites you in the growth equity space?
Yeah, no, thank you, and thank you for having me. It's nice to catch up with the community. So my name is Julia Monfrini. First, can you hear me okay? Okay, great. I'm the founder and the managing partner of a firm called Pace Healthcare Capital. We do investments in healthcare technologies, so software, data, AI for healthcare. No medtech, no life sciences. We do what I call early growth, meaning our portfolio has the juice of venture, the resilience of growth equity, and the liquidity and DPI of private equity. And so we really pick our spots. Our Fund 1 is outperforming top decile funds, and we've had our first exits and 0.5 times DPI. So we've really picked our spots in healthcare and brought a lot of discipline in the early stage investing. What gets me excited, what keeps me up at night, Well, my sector continues to get me excited, especially in the current environment. One, obviously, we can always find great companies that drive attractive returns, but right now the market dislocation is so acute that it's an ideal time. Healthcare is generally recession proof. We saw it in 2007 and 8 and 9, not a blink, not a flickering in healthcare expenses and growth. All the large groups, whether it's hospitals, whether it's pharma, whether it's distributors, are all looking to deploy technologies to first drive revenues, second cut cost, three occasionally drive patient outcomes, but it's really in that order. And today, where can they find value? It's really in technology and in software and how to harness AI agents, for instance, to support nurses in their job and a variety of things. So that gets me excited. The market dislocation and the volatility is creating very interesting opportunities in terms of pricing. So we're very active with deploying capital right now.
DPI, and talking about credit, people don't think about exits per se. Sometimes their exits are permanent financing or bridge loans, but how do you see the M&A exit? Man, you're earlier still. Just how do you see, because you have some DPI already?
Yeah. Well, so we've sold actually a company a couple of weeks ago. It was our first investment 4 years ago. And it's again, we find that if you're not trying to build a unicorn and you're not overpaying at entry, which tends to be a flaw of venture, but you can really engineer against it, you actually don't need to wait 10 or 12 years to drive a good return. Within 4 years, you can drive a really, really good return. And the M&A market was at a standstill for almost 18 months, right? Interest rates went up and it became too expensive for strategic buyers or private equity to acquire anything. The math just wasn't working relative to where many of the valuations had been, and it brought almost everything to a standstill. But now things are restoring, and we see a lot of people, private equity in particular, with dry powder waiting on the sideline to do a deal. So the momentum is picking up. There was a moment of as our banker described it, euphoria in the business world post-election before inauguration day. Thankfully, that's when we priced the deal. Closing it in the current environment was a challenge. And I say this as the executive chair, so I have more weight here now. It was hard to land. It is very chaotic out there. The constant negative news cycle creates fear. And so while the business community, and I'm here not making any political statements, but the business community was looking at the Trump administration as being potentially a golden age with less regulation, increase in tax cuts, and potentially just more space to operate. And I think there is a bit of coming back from that just because of the news cycle, the tariffs as well, etc. So the M&A market is probably not going to be as strong this year as what everybody had hoped, but there are pockets of opportunities.
So you wear lots of hats.
Yeah.
One of the hats is you're like an LP in her fund.
Yeah. And it's I don't have to sort of think twice. I don't have to think twice about complimenting Julia. Not only did she do very well with our investments in two of her portfolio companies, she seeded one of my best friends who is now a triple-digit million company. And she just exited her first portfolio, and she does that while looking fabulous, which is nice, but also having a team of great diversity, and is in a marketplace where you don't realize it's not the epicenter. So she's in Chicago, which is not Boston or not Silicon Valley, and as a result of that, she picks up these sort of. We call it esoteric, but I'm using it in a positive way. Esoteric opportunities that other people don't see because they're not there. Like Silicon Valley boys fly over Ohio every day, right? Similar in healthcare. and so that allowed us to be very comfortable with sort of financing her projects. Also, she's incredibly thoughtful and has one of the best decks and analysis, which we really like. It's almost too much. You know, you get almost too much information, but it's very good. So that's, you know, it's a little bit about that goes to selecting managers and you feel comfortable with, because they do their job. They have a specific angle, specific thesis that they relentlessly focus on, and today she marches to the same drum as 5 years ago, which is nice consistency, and the results show.
Thank you, Eddie.
I think I paid
I will-
for this, by the way.
I will- yes.
More broadly than Julie's funds and the private equity, you talk about private credit. How did you think your family, if you go to Markowitz with, you know, you have 5 deals and he's looking at, you show him a private equity deal versus a private credit deal, like what kind of return structure, what do you have to do to get the yes?
Yeah, it's obviously very different, right? We look for a very different thought process around private equity, and very different thought process. By the way, Julia is sort of in between venture and private equity, I would say. It's more growth equity.
And to be fair, it was 4 years ago, which was a thriving venture market.
Yeah.
Which was like,
Yeah,
we gotta go
Yeah.
into this.
exactly. So the thought process is very different. The equity returns, frankly, because the returns on private debt right now for us in our family office are, you know, high teens, low 20s. That's the marker for private debt. The market for private equity, because of the risk return, is significantly higher. So it'll be 25 plus on and on the specific projects, probably more than 30. Otherwise, the principal will say, well, if you can get this with collateralized debt, why would you take that?
Back to Matthew, like what, let's just say theoretically, you want to give him, he wants 10, 15, $20 million. And you would, you probably, I'm guessing your answer, you would probably do a structured debt deal so that he gets what he wants and you get what you want.
Yeah, probably layer it to 2 different ways. I layer some portion of it as sort of private
I'm
credit,
trying to structure this for you, man.
and have significant
Eddie and I have
collateral.
spoken.
I believe there's lots of upside in this particular climate for him, particularly because his competitors are not so well situated versus him in terms of tariffs, right? He has a very low percentage of Mexico and Canada versus a lot of other people have higher. That's a separate conversation. So a tranche of debt that where you have significant collateral, the entire, as much as you can get, and then the rest is sort of equity, which sort of, I would say, operates as equity, but can also convert and is preferred.
I guess that takes us to you, Carl. You're trying to figure out your equity debt stack. And you might want to remind people who weren't here this morning what it is you do to help the world and make a lot of money.
Yeah, what I have is a company, we take end-of-life tires, there's one for every one of you out there every year. And we recycle those back to the base chemicals of carbon black, and then the liquids we convert back into limonene, which is your lemony fresh cleaning smell, jet fuel, and a viscosity modifier. And we're pleasantly involved with 4 projects here in the States that we own between 25% on each one of them. They're all about, the most expensive one's 245 million. The other one is, say, 200. But they all will roll about $100 million worth of profit each year. And they're up in 18 months.
So how do you look at the capital stack? You're mainly looking, you got offtake agreements, right? Under major revenue flows. This is proven, it's not a new kind of technology.
Yeah, correct. We have offtakes on all of our products coming out. We have insurance on plant performance and on construction schedule from Munich Re. So they're covering us there. We have back-to-backs with everybody else. So from a cash standpoint and a risk standpoint, I'm an old risk management guy from Westinghouse. I used to do their nuclear plants. So we sort of covered ourselves there. And now with each one, there's a major international equity investor on all four of the plants to the tune of about $1.2 billion. So, but he's taking a nice piece of chunk of the money, but he's not charging interest, which is good. So that's how we've basically structured ourselves right now.
I think the opportunity for this crowd is, I think, more to be in your whole.
To the holding company. Yeah, so
We can get into, he's got 12 plants he could do, each one could, create about 60 million of EBITDA. There's a rev share with the partners that do those plants, or 250 million plants. But Holdco investment now gets us into, it advances all the projects, so it's entitled, gets moving toward the end of the technology.
So what in the base case are you offering, Carl?
okay, on a basic, an holding company, which is where, our piece of the action of all the SPVs is where we own all the patents at that area. We license those plants at $1 million a pop. There's a recurring license on those. We get 8% royalties on all the products that come out of there. Plus, on our construction cost of actually building them, we're at a 30% income before taxes. And we're basically looking for somebody to help us break away from the parent, the big investor, to invest in the holding company, because we'd like to expand our business out and go worldwide, in which case then we need to staff up with some engineering people and some marketing support.
But what are you offering us?
But anyway, we don't go into that. It's getting closer to a securities discussion.
Okay.
It's the principles of it and how you look at the.
Turn off the camera. We're doing deals here.
Finra still lives.
Sorry.
With the camera.
I'm just joking.
But just talking about the equity the markets, I do think there's an equity opportunity in the Holdco. Obviously, you should be able to build debt on the stack that you have with those offtakes. You're still going to need pref or other equity. But I think that's probably from a strategic that really gets it. And I think the family office opportunity is more in that Holdco.
Mm-hmm. Yeah, so we're basically looking to, for about $20 million, we're looking to slide off 25% of the Holdco company.
Thanks for answering that question, Freddie. Yeah. All right. So I just wanted to get the private equity landscape of how you all see it from your purchase, what you're looking for returns wise, and other comments you may have. And then we will have 4 breakouts. Private credit will be here. On real estate, we'll have the public fixed income structured products and both those breakouts. And then I think private equity will be with me in this room somewhere. Questions? Oh, look, it's here, James. Elvis is you look more like Elvis before, but
Trying something new.
yeah. So questions, comments? All of you. Firstly, you're lead private equity and M&A. Murder, come up here. Introduce yourself, and then maybe how you see this private equity marketplace today. She leads the practice here at Baker. So.
Thank you so much. I'm Murder Bacher. I'm the head of the financial services industry team here at Baker Hostetler, which is the largest U.S. only full service law. Right, so we have 50 state coverage. We can solve your legal problems anywhere here in the U.S. Of course, we partner with best-in-class people everywhere else. I tend to be provocative, and so why don't I say something provocative, right?
The lawyer's gonna say something provocative.
I'm too provocative for a lawyer. No, so as you mentioned, we had 2 years of essentially no M&A activity, and some of that may be owing to interest rate environment. Is there a possibility that some of it is owing to the fact that private equity has squeezed out the value in the existing business model, right? And we've sold things, we've sold them again to other private equity firms, we marked them, and now really we need to see some more creative strategies to realize value.
Great question. It's possible. It's possible, and I think both the value creation aspect is not uncorrelated to the low interest rate environment, because in an environment where money was virtually free, there was just an incentive. If you look at, so my previous job before starting my own firm was to lead private equity for healthcare for a sovereign wealth fund called CDPQ, Caisse de dépôt and placement Québec, 400 billions of assets under management. And it's a young province, so they didn't need the capital to support retirees. And when you were asking the constituents, what do you want? Do you want stability? Do you want credit? Do you want more return? The answer was always hands down more returns. Just build the capital for the long term. And what that meant, looking at a portfolio, was doubling the allocation towards private equity. And when the cash does that, it's $30 billion that moves, right? It's a large amount of money. What that means is, okay, where do you put it in private equity? Well, there are funds, and funds grew bigger, right? Blackstones and KKRs, they all grew bigger funds. They could therefore afford to pay a little more, which created a vacuum effect to pick up more and more assets at higher prices. It's also called inflation, right? It became just more and more expensive to buy the same thing. Then others went to start deploying in direct, which was sort of my job. Find new things that don't exist, create new deals. And we were very creative at doing that. But it is also true that we had almost a decade of bull market in valuations. So once you've done a number of things, then what do you do next? And I do think there was a next chapter. There was a next chapter around technology. We're still in the early stages of seeing truly how software, AI transform old economy businesses. That sort of stopped with M&A crashing, which I attribute to interest rates going up. But I'm hoping that this drives the next decade of value creation, and that it also forces more discipline on managers and in PE to actually drive value creation. But it was a great question.
Anyone else?
I have a question for you.
Sure.
Just feel free to correct me, because I'm not a private equity guy. So, observation is that, go back, private equity went in with some equity, bought a company with some equity and a pile of debt. Company made money, paid down the debt, now you own all the company, okay? Fine. Private equity sells, you get paid, all good. Seems to me at some point, the game changed, where now you buy a company with a little bit of equity, you put a lot of debt on it, you pay yourself first, and then you see what happens later. I mean, I'm being a little facetious, but you tell me.
No, that's real. But I mean, I've been seeing that for a long time. It may be that people have finally caught on. As am I. Dividend recaps are not new, right? And that was the first thing you did. You tried to take your money out as quickly as possible, and we try to protect in the documents, right, so that investors are not taken advantage of in that way. But definitely, if those protections are not very carefully put in place, that has and continues to happen.
And how much of a problem now versus the past do you think that is, or is it not much of a problem?
I think it's a real problem. Again, I'm going to be provocative here, folks. So
That's my question.
There are two problems that come up against each other, right? And I think the problem that you try to solve in groups like this, to some extent, is how do we make sure that fund managers do not disproportionately benefit, as opposed to their investors, right? And so that's one problem. And the other problem that you weigh against that problem, I think we would all agree on this, is, well, how do we make sure we have enough expertise in our deals so that we all make money, right? And I think those two problems are constantly in tension with each other. And so you need to reward the people with expertise to manage the funds, to grow the pie for everybody, and you need protections when you're in an LP capacity or in a co-investment capacity to make sure that you also participate in that growth. And yes, the answer is lawyers. We actually know how to do this. We
I answered the question on purpose, not really.
But
we know how to protect it.
And he's gonna be provocative.
yeah, I'm not provocative, but the interesting is a lot of you guys may have missed the session we had this morning with a lot of family offices there, where the gentleman who was presenting, Bill Deukler, who's sort of like the eminence grise of the family offices almost, he proposed a model, sort of allocation model that provided for 25% private debt. And that has partly to do with the asset class private equity being really disappointing. And going forward, the asset class sort of public equity is also not likely to outperform. And that was sort of well met. That wasn't sort of, oh, that's so strange to have this sort of relatively new 1.7 trillion asset class being 25% of your portfolio. That was sort of like, yeah, that makes total sense. And we've had, this is obviously today, we talked a lot about debt in various forms. But I feel that asset class is sort of setting the bar higher for private equity. And I do work with a number of family offices that actually have that as sort of the lower mark on their private equity sort of expected returns, which is high teens, low 20s. And if we don't see an easy path to get that, then it's a no-go, because fundamentally it's the private credit is less vol and less risky.
Can I say something? Because this I have seen, and it's actually become a problem in deal making. Because now everybody just wants to lend, right? Now that's what everybody's fixated on, and they want to go into the capital stack as debt, not as equity. Capital markets don't work that way, right? Like this is developed over time. There needs to be equity in deals, and it should be the residual value, and it should have a disproportionate share of the return because it's taking the disproportionate share of the risk. So I do think there's a recalibration, but the precise point you're making is one that I'm seeing affecting deal flow right now because there's just not alignment on it. But that's right. I can stop being provocative.
No, you're now moderating.
Wasn't that
Go on.
Come on, you can.
Other questions, comments?
Can I poll the audience for a second? Who is interested in, especially given your comment on private credit, which I think is spot on. How many this year are looking to deploy capital in private equity or those private asset classes?
Private equity and debt, or just private equity?
Private equity and through venture in.
You mean like a fund,
Yes, or deals.
like a buyout? We would do, but
Buyout,
We've never-
growth equity or venture versus debt versus. No, it's a good question. I'm trying to see who is interested in equity risk.
Yeah, exactly.
Yes,
Yeah.
relative to debt.
yes,
Yes.
we've done a buyout.
So a third of the room, which I think is interesting, because if you asked that question 3-4 years ago, it would have been.
3/4 maybe.
Yes, exactly. It's an interesting change in temperature in the market.
We had a question earlier today about returns, and I guess we talked about that. Those who would be happy with 7 to 11, that was 11 to 19. And the 7 to 11.
Percent?
Yeah. The 7 to 11 just beat out the 11 to 19 for your overall portfolio. You'd be happy with 7 to 11.
Yeah, overall portfolio right now. It's just okay. That's.
I think that's what I deliver. I don't have a job, but okay, carry on.
30, 40, unless they get 30, 40%.
Mm-hmm. But it's also return relative to risk, right? And is it also actual returns? Because especially in equity asset classes, there's a lot of I wouldn't say necessarily gaming. It assumes ill intent, but there are practices on marks that can lead to misunderstanding on what the actual value is on the back end. And so it's interesting to see how in the last 5 years there's been a sort of back to the basic, back to the fundamentals. That was, I think, necessary. There was certainly a lot of wrath in the market before that.
Plus, we have a new dynamic. The secondary markets are much more voluminous and they're creating the marks. You can't argue with those marks.
Mhm.
Other provocative questions or comments?
I got one.
Yes.
So if we're in this world where everything's about debt and you can get 18 to 20 returns, how do we get back to equity returns kind of getting normalized where you do want to put equity into deals and we start seeing more deal flow? Does that make sense? Like if you're just getting great returns on debt, why do equity? Why invest in new companies? Why grow other companies if if your returns are good enough? What's going to change? What has to change for those returns to go down in debt?
Yep, I'm happy to start and then you feel free to chime in. One is I do think that equity should continue to yield above 25% on a net basis, right? This is the appropriate reward for the risk. It's not the IRR you see these days because there is compression in the market and pricings were very high and M&A was done at high prices in 2020, 2021, 2022. It's now normalizing, which is compressing returns, but generally the reward should still be, and what a manager works for is still that target. There is an assumption on mezzanine or private credit that it may yield 18 to 20%. I think this is what's priced currently. We still haven't seen necessarily defaults, so it needs to survive the recession, which depending on what data you look at, and maybe this was covered today, is somewhat already here. So it doesn't price default in it. And I think we'll see real returns way lower than that in the private credit portfolios. AD, maybe it's an
Yeah, I
area you know
think
very well.
it's a maturing industry, so over time, and you double from 1.7 to 3.5, you will see rates compressing significantly, and that's sort of the 18 to 20 is a higher end of the return. There's tons of that does 8 to 12. So I think that's the average is probably significantly lower than sort of the what we mark for, but we also incorporate significant amount of risk with acceptance of some default in it too, right? So it's not there's no panacea here. There's no sort of magic wand that say, oh, don't do equity, and that doesn't. That's I don't think that exists in the long run, at least. Short run, sure. There's probably a couple more years there if you choose well. But that's a interesting thing. We had this conversation about the private equity managers. You see a massive spread in between the 25th percentile and the 75th percentile returns. More than 10 points, I think, in the discussion this morning. So it's the headline is misleading. You also have to pick right. Not only let's put some money into private equity. Well, if you don't pick the right manager, it may be 8%. And so conversely, when you are lucky enough that you have the relationship and pick the right manager, you can do top quartile results, which still net you over 25% today. But I think both those rates will compress. Mostly the private credit will compress to probably lower teens, and then there's reason for private equity fundamentally should be rewarded 25% ish. I think.
Eddie, would you say that credit defaults are correlated with private equity bankruptcies as well? The circumstances?
Yeah, I understand what you're
Somebody
saying.
says recession, well,
Don't know how they're probably related, but don't know how. Yeah.
So
I mean,
one-
that's a generalization.
Yeah.
So one thing we're seeing just related to that is as private debt got hotter and hotter, right? They accepted terms that were less and less protective, right? So from what a lawyer would like to see, they started lending with fewer protection. So
Of late.
yes, so we can expect, manager selection to have been very important, right? And people who didn't take undue risks will
Oh,
perform better.
Credit is recovery process.
What, right, for the.
Some don't have it,
Right.
and some are really good at it.
Interesting point. A side point, but on the infrastructure credit recovery rates are very high. Fundamentally, that's a sort of I didn't know it until I looked into it. The 5-year recovery rate is 97.4% or something versus an industry average of 92%. Massive difference if you look at it in terms of returns. And hence, that's why we gravitate towards looking into and heavily investing in this, because recovery rates are very important. Time for the breakouts, Mark? I'm just saying.
Breakout. So let's explain how we do breakout. This is the 360 and 361 firm. And it started because of my frustration. I don't know why. Because I come back and I had these, I went to an alumni event and it was just random. And I got lucky to meet somebody or I didn't. So what you want to do, so we've got 3 rooms here. We got a room, we'll call it the coffee room, where people are having coffee. Then we have the lunchroom, where the box lunches were. Then we have this room. These are the 3 rooms we got. And the way it works, whatever you choose, it'll be real estate in one, public fixed income, structured credit. The other, here would be along this side. I'm going to maybe rejig the tables a bit. We'll do it sort of cluster here. We'll have a roundish table, private credit. Over there will be equity players. They might at some point. Food is being brought in, as you can see. So you can grab a drink, perhaps grab a bite. But when you get into this room, I need leaders, co-leaders, to make sure that no one riffs and talks too much. And it's all about getting to know who's in your room very quickly, your name, your firm, and let's say 1 sentence, not a run-on sentence, but just what you do in 1 sentence. That establishes that should be very quick, and everyone knows who's there. Then I'll be walking around. Then we'll basically try to talk about, the perspective of what you heard today. And then toward the end of that discussion, we'll have takeaways. Takeaways would be, should we have a real estate event? Should we have this public, fixed income or structured credit event? That's all we talk about, instead of having half an hour. And every Tuesday and Wednesday, we can have such an event. So every Tuesday at 11 o'clock, we have our briefing. Where's Stephen? Where's Stephen Burke?
Yeah, just left.
His computer's right there.
Anyway, he's always here, except for the moment I need him. And then right after that, 11:30, we did health tech last week. We can do a deep dive on any of these topics. So I just need somebody. I need 3 people to be on a panel. That's all. And it's kicked off. Don't put on the schedule. So that's one of the takeaways. Or it could be a summit. This is a private credit summit, came out of the same discussion. So again, you can sort of stretch, take 5-10 minutes, come back in this room. If you want to be in private credit, we'll set up, let's just sign private equity, venture, any equity will be on that side. Real estate is coffee room, the esoteric structured credit, and fixed income will be in the lunchroom. And I'll make sure that I need somebody that is in control of having everybody introduce themselves, and so it doesn't become them, right? No sidebar conversations. That's rude and inefficient. Or they can do it now. Okay, you got that? And then when we're all done, we debrief on what the takeaways were from those sessions of breakouts. And then we all go to wherever a defender thinks we should go.
Are you celebrating?
All right. Mark, I am logging off. I got to go interpret the liberation tariff announcement.
Yeah.
Steve, the place has changed.
Doing so well.
It's a great place for everything.
Yeah, so it was nice for a bit.
Come join our 361 firm community of investors and thought leaders
We have a lot of events created by the community as we collaborate on investments and philanthropic interests. Join us.